Tuesday, the 11th of July. Just getting the briefing underway and starting off with the close on Wall Street, where we had a positive close, up 0.1 on the S&P, Nasdaq up 0.67%, so you continue to see a bit of a discrepancy with the Nasdaq. Tends to be either an outperformer or an underperformer. The Dow, though, did finish down slightly, about 0.2%, but in summary, yesterday was fairly difficult in terms of trading conditions, just given the fact that it was particularly quiet, given a lack of calendar events, a forward-looking kind of participants in the market for midweek for Janet Yellen's semi-annual testimony, and then events thereafter, inflation data from the US at the end of the week with US earnings commencing, so on and so forth, meant that yesterday was pretty quiet overall. Did see some movement, but a little bit difficult to get a hold of really the sentiment, which was, I guess, moderately positive. The one thing is, I guess just looking at the S&P here, you had a bit of a dip yesterday towards pivot, but really the day's range, for the most part, defined by pivot and its R1. So the high that was seen on the previous Asia Pacific session was also what capped price action towards the latter parts of the close on Wall Street. So I guess when it is a day like that and the market's quite forward looking to other events to come, it's just about being a bit realistic, I guess, with the approach to adopt on that particular day. Yesterday's pivot obviously lined up quite nicely with that previous low. We were looking at this when we were kind of going over the midday strategy yesterday. Although the strat itself was looking at a short from the high on the 5th, certainly I guess you would have need to have been pretty confident about this kind of buying the dip mantra lasting for the moment. But there was a pretty decent level technically where the market eventually bounced and recovered. And we're pretty much mid of that recent range that's developed over the last day or so now in the S&P. Looking at the DAX though this morning, following on kind of a generally positive Asian session, has seen European indices move a little higher this morning. I know some of you caught hold of a bit of the DAX action on the break of a key level this morning. You can see here really encapsulating the upside, the range that's been in place since the beginning of the month. A break of that also with R1 being taken, so a pretty quick move all the way up to R2. You can see that level there was previously support back on the 18th, and again that kind of cluster of price activity on the upside that have really held the price action since the end of June, breaking and hence a bit of an extension of the move. If you look at where it's popped to, pretty much back towards the lows that were seen end of June and also on the 26th. Not too much in the way of specific news, but again, just more of a technical break, and knowing what the DAX is like when it tends to break these key levels, it moves pretty quickly. Consequently, T-notes down about 5.5 ticks. So a bit of reversal from yesterday, which broadly speaking saw a bit of profit taking from the pretty steep downward trends that we've had in fixed income markets of late. But I guess admit some of the positivity with the open this morning. You've got bunds down about 37 ticks, so just giving back quite a large portion of those gains that were seen really this time yesterday. We've already taken back most of that move. I guess downside in the bund, if we put this chart a bit longer dated, there certainly is that low printed on Friday last week, down around 160.31. Would be worth keeping a close eye on, given the fact that we've tumbled so quickly from really 165 down towards 160 in the last 2 weeks amid this kind of hawkish turn by a lot of the central banks. Consequently, with this kind of sentiment play this morning, moderate risk on, so the Japanese yen weaker. If I just bring that into shot, that's found a bit of resistance thus far at R2, and then as such gold price is also a little lower this morning, sub pivot while we're speaking. Just keeping an eye on the currency pairs as well. The dollar pretty flat at the moment, but just giving back some of the gains that were seen during the Asia Pacific session. So both the major pairs seeing some moderate upside here as we deliver the briefing this morning. Pivot just being tested in euro dollar. I guess though, looking other than the pivot, it's a little bit mid-range, I guess, of what we've seen develop over really the last couple of days. But certainly it looks to be more a bit of a pullback in the dollar rather than anything specific in these currencies here. Likewise, cable coming up to R1. That's pretty close proximity to the pretty good level pivot was yesterday. You had to be pretty early to get in on that short, but it did work out very, very nicely yesterday for an eventual run. And I know a few people got a little bit caught out trying to trade that break of that key technical level. It was on the Friday low and also that high that was seen back on the 27th. I know a few people were trying to short the market there amid kind of some of just the general negativity surrounding the political situation and Brexit talks and so on. But that really failed to materialize yesterday. But coming back up here now in cable again, R1 was pretty much that level yesterday, so it might be an interesting level just to keep an eye on here in the sterling currency. Talking about central banks though, some couple of interesting graphs I've seen on or infographics on Bloomberg this morning, and worth just recapping, because I guess from a trading the news point of view, when you're listening to central bankers, a lot of the questions you have to ask yourself is, which central bank is causing the most volatility at this present point in time? And you could argue that with the Fed kind of sticking to their predefined kind of script and not seeing much deviation from that, actually it's been fairly uninteresting to trade of late. Now this could all change. Obviously on Wednesday you get the first, which is the most important delivery from the Fed chair Janet Yellen, as she delivers her testimony to the House. She'll deliver then to the Senate, which is a repeat on the Thursday. But arguably it's ECB's Draghi that many are pinning this big kind of recent repricing, particularly in the bond market. We just looked at the Bund there, having dropped from about 165, a full 5 points down to 160 in just a matter of weeks, which is a pretty phenomenal move and how quick it's happened. And a couple of market commentators this morning, BlackRock, Goldman's asset management division, talking about the ECB as the greater market driver at this present point. And a couple of charts that Bloomberg are kind of putting together to showcase that. And we're looking at the steepening of the 2s, 10s yield in Europe, and you can see the blue line, the euro, or the benchmark as you would call it, being the German yields, seeing the greatest amount of the 2s, 10s yield curve steepening comparative to its counterparts in the likes of the US, Australia and Canada, for example. In terms of the actual basis point move, it's been much more aggressive than what we've seen in those other central banks. The other thing that's been interesting here is about the implied interest rates and what we were priced for a year ago, what we actually are now, which is the blue, and an implied rate for a 1 year from now. So where do we see interest rates in the future? And as you can see, if you're looking across, these are the currencies, but you can kind of extrapolate that to the central bank itself, and you can see that there's a pretty distinct theme here where, as you can see, a year ago to where we are now to the future, it's an incremental move higher, i.e. so the Fed, if we're looking at the UK, Australia, the RBA, a little bit more mixed in terms of the RBNZ, but the Bank of Canada and the SNB, all of them you can see the far right, kind of the orange colour, I should say, or tan colour, is more higher than it was than a year ago. So indicative of the fact that we're pricing in the fact that policies across these global central banks are going to be showing tightening in the future. Hence the reason why you're starting to see, and the trigger point very much has been the ECB, given its very expansive long-term strategy of a loose monetary policy. The tightening of that is what causes some nervousness about how the market might react. The euro, you can see here, the one, of course, that has been pretty much a flat line and has probably seen the least change. Look at the changing in expectations of rates for Japan from a year ago to now to the future. It's absolutely nothing. Just kind of cemented then by what we heard from Kuroda, those comments that we saw more recently, where they've got the most bullish that they've been in many years on regional economies and the breakdown of Japan. However, they see absolutely no need to move away from their ultra loose monetary policy. So therefore, markets are not expecting anything in that regard going forward. But certainly the future interest rate paths as priced by markets are reflective of this more hawkish view. Currency-wise, the euro as well, just following suit. As you can see here, from where we were really looking at the end of last year to where we've come to now, this kind of increasing idea of inflation, then to be followed by a more hawkish turn in communication, has certainly seen the euro climb to the top of the currency pile, outperforming the dollar index in that respect. And if you're looking at the actual currencies, so the current position and year-to-date change, even though the Fed still remain fairly resolute that they're going to continue upon their kind of path of interest rates, so one more interest rate hike for this year. They're also talking about tightening of the balance sheet before the year end. These are all hawkish things. The only difference here is that the other currencies, if you like, this divergence of monetary policies has started to converge. And that's not so much the Fed, because as I said, they've kind of stuck to their same line throughout. What it is the Bank of England and the ECB all change intact. And so therefore those currencies starting to catch up. And as you can see here, the euro year-to-date change, pretty decent move, but it's actually the pound that's shot higher. And this of course comes with inflation in the UK tracking, I think it's currently the highest since the summer of 2013, obviously at 2.9% at the moment. So just quite interesting to see how, when you start looking at the various different ways of looking at the market, all reflective of this recent hawkish turn. Talking about the UK, and just having a look at a couple of headlines this morning. This is probably one of the most unsurprising headlines, but something to be aware of. UK shoppers spend more on essentials as inflation rises. So British households spending more money on food and other essentials last month, but held back on less urgent purchases. This of course coming as they face continued pressure on their household incomes, and savings rates are currently tracking at record low levels. Now if you actually look at the BRC measure, the British Retail Consortium, they said its measure of retail spending growth rose to 2% last month in June from 0.2%. That's actually above the average of 1.4% of the past 6 months. So you might say that was pretty good for June. However, the actual chief executive of the BRC itself, Helen Dickinson, did say that its pickup reflected a temporary boost. If you remember, in June we've had exceptionally warm weather, and that has helped lift clothing sales, as well as higher cost of food. You also had Eid as well, which typically also helps accelerate some of the spending potential for the month as well. So although it was up, you could say it is slightly skewed by the seasonal factors and weather as well. Looking at Barclaycard, they also had some other data out from overnight telling a fairly similar story. As a result, consumer spending's contribution to second quarter economic growth, which is adjusted for inflation, may be limited as a takeaway. And of course, this comes after Mark Carney said that the extent to which consumer spending slows and whether stronger exports and investments can compensate for this will be important for determining if the Bank of England starts to raise rates. Remember, he has been a little bit more hawkish of late as to his overall, I guess, Bank of England. However, if the consumer continues to feel the pain going forward and conditions continue to deteriorate, again, it's going to make it incredibly difficult to see this 5-3 hawkish split we had in the last minutes convert into something toward actual action. I still think that's highly unlikely in the near term. Sticking with the central banks, Fed's Williams still sees rate hike asset unwinding this year. So he said expected one more rate rise in rates in the Federal Reserve this year and for it to start unwinding its massive balance sheet in the next few months. So this is exactly in fitting with what they said in their last kind of statement from the Fed, so pretty unsurprising. Williams emphasized that if inflation did not accelerate as expected, that would argue for a much slower pace of rate rises than currently projected. So again, inflation is key. That's what the Fed members are telling us from what they're basing a lot of their decision making on, and they are willing, according to Williams, who I think is a non-voting member, to alter the trajectory of rates thereafter. Again, it's not so much about the interest rate this year. We know that they're likely to execute that probably either September or most likely December of this year. It's what do they do thereafter that's going to be key. Back to the charts then, a quick look elsewhere. Let's have a look at oil. And saw some, well, if we have a look first of all, yesterday, again, pretty difficult trading conditions because initially we were under some pressure. Now this almost felt like, if I highlight it, this was the UK and European reaction to the fact that US oil rigs was +7. This Baker Hughes number comes out on Friday night, so typically a lot of UK and European investors are already away out of the market, and then they react to it. And the reason why it was significant this time round was because we had seen a contraction of rigs the prior week, and that was the first time we had had that in about 23, 24 consecutive weeks. So it was almost like, okay, we're back on track, rigs going up, US output then will continue to be on the rise, prices came under pressure. We broke fairly early in the session yesterday the previous low from last week, which kind of validated the downward trend that had taken place over the last couple of days. However, it really failed to make much headway to the downside, and then we recovered, we broke pivot, some stops were run, we got up to test up at around that high point that was seen on Friday's session, and actually we've had a little test on there as well this morning. We initially tested it yesterday in the afternoon session. We've had a look at it again this morning, so maybe worth just keeping an eye on that 44.88. Then obviously above you got the 45 figure followed by 04 for the R1. But in terms of commentary this morning, this is Goldman Sachs. They put out their latest research note yesterday. Now, for those of you who've been in the market long enough, you probably know about Goldman Sachs and their accuracy in calling markets in terms of specific price targets. They tend to be, I'd say, well, not particularly accurate, or they tend to change their view quite drastically. And I remember, I think it was Citigroup that was talking about $60 in the coming months. I think Goldman's was certainly in that camp. I believe Goldman's were previously looking for $55. They've now revised that to 40. Pretty chunky revision, one would say, $55 to $40. But looking at the breakdown of what they're saying, and it's nothing really particularly new, I would say, yeah, as Piers has quite rightly said, you know, if they're cutting their target, this time to get long. It tends to be a bit of a joke in the market that we have. Whatever Goldman says, you kind of do the opposite. But looking at what Goldman says is that OPEC must increase output cuts aimed at shrinking a global glut with little public announcement in order to jolt investors, is what they're suggesting. Without such action and no evidence of sustained declines in inventories, as well as US drilling activity, prices could slump below $40 a barrel. Obviously $40 is a very interesting price point as well, and just quickly, we were if I put it on a daily continuation, just tidy this up slightly, is we got down to 42 more recently before we had the pretty phenomenal bounce up, and we've kind of paired about 50% of that move. But 42 was quite significant because if we start looking further back, we go back to kind of US election time last year. We did briefly get down to 40 and recovered in the summer of last year. But the point being is that $40, although US output has been rising quite rapidly, it does start to get to a price point where it starts pressuring the break-even prices of the shale industry itself, which on average I guess probably tracks somewhere in the region of 35 to 40 bucks. You tend to see credit spreads start widening for energy firms, which then makes them less committed to investing in the sector. And so therefore, actually, I think getting under 40 would be fairly difficult. That as well, in combination with the fact that OPEC obviously are fairly likely to start getting more vocal in towards stepping in, or stepping up, I should say, their production. Whether that's extending, I think we heard from Morgan Stanley at the end of last week, they're talking now, floating the idea about OPEC extending this output cut production deal to the end of 2018. We are currently due to finish at March of 2018, so they're talking about exceptionally long periods of time to extend. We've also had lots of murmuring about a cap for the likes of Libya and Nigeria, and then we're also talking about deeper cuts. So going beyond this 1.8 million OPEC non-OPEC deal cut, start upping the size of the cut, something to 2, 2.5, and so on and so forth, to make it more meaningful. So yeah, quite interesting to see these banks changing these kind of views. I wouldn't really read too much into it. Certainly it's not a tradable event, so to speak, but it's always good to hear what it is that these guys are looking at. Having a look actually on this note of OPEC and the deal, I was looking at the compliance levels this morning, and interestingly, for the last 3 months, so this is measurement of March, April, May, OPEC continued to be over compliant, which for those who've traded many years, this is a highly unusual situation where they typically are very bad at sticking to their quotas. Now, what's interesting here is the likes of Saudi Arabia are cutting in excess of what they actually need to, whereas the likes of Iraq, for example, which I think is the third largest producer within OPEC, they're currently not cutting enough. So there are discrepancies. Although these are the overall compliance level of OPEC as a group, which is over and above 100%, the breakdown is actually quite interesting to see that Saudis are actually carrying or shouldering a lot of the burden. The more interesting part here is the non-OPEC nations. Now, I guess the one thing that might soothe some people's fears about the effectiveness of these cuts is the fact that from February, March, April, May, at least there has been a bit of a growing theme that the non-OPEC nations are slowly but surely becoming more compliant. Now, Russia, of course, is a key component to this, because Russia actually produces more than any other OPEC nation, full stop. And so if you want to have an underlying impact to influence the price of oil, then certainly you need Russia to do its part. And over the last few months, they themselves definitely have not been pulling fully their weight to an 100% level, but we're getting there. And so this would be something interesting to monitor as well going forward. What is the non-OPEC compliance levels? Do they continue to come up to the point of hitting that line there? Okay, moving on, another subject to quickly get you up to speed on. We've looked at cable this morning. You can see here we've had a quick run up, but it's a bit of a pullback, pivot working quite nicely there in the euro on the initial resistance point this morning. But we had some pretty shocking news actually yesterday, and really the Conservatives, I don't know what they can do to do any worse a job in PR at the moment. But Theresa May's bowed to pressure and suspended a Conservative MP, the lady you're looking at, who used racist language in a move that further erodes her party's already wafer-thin working majority in the House of Commons. So this is MP Anne-Marie Morris. She used a highly racial comment, which has obviously created a significant backlash, quite rightly so. But this is important for the reason that at the moment the Conservatives have what the FT are deeming a wafer-thin working majority. So don't forget, with the DUP, they only have a 13, I think it is, seat majority. That's with the DUP. So subtract now this MP out of the equation. That's reduced it to just 2 Conservatives. That tips them kind of over the line. You need the DUP's 10 as well to get you into a workable majority. But it's getting awfully close to the wire, to a point where there might not even be enough Conservatives to have even a working majority. If, say, another technically 3 Conservatives were to be suspended, for example, or removed, that then would mean they haven't even got a working majority with the DUP. That would spell then renewed political uncertainty. You've obviously had Jeremy Corbyn talking about, I'm not the opposition, I'm the PM in waiting. And who's to say then that this doesn't start to get the ball rolling on that type of political movement? So, yeah, pressure already for Theresa May from multiple angles. And this is probably the last thing that she needed, but it just keeps coming. The negative PR for the Conservatives. The other thing that's happening is on the other side, let's say, of the lower house, is led by Labour's Chuka Umunna, who has a cross-party group. And they've been pushing for something quite interesting, because what they're saying is that all options should remain on the table in Brexit negotiations. So this is a cross-party group. It has people representative of all the different parties, and they're not saying they don't want to stop. They're not saying they want to stop Brexit. They're saying, though, that we should be a little bit more realistic, and the fact that we should remain in the single market and do everything in our interest to secure the best deal and maintain the closest links with the EU. You know, it's this kind of... This seems to be growing, I would say, from what we tend to be reading in the press, this sentiment now. I think I'd be interested to see what the polls would suggest of the people's sentiment about Brexit overall. I, for one, would have this feeling that more people now tend to be erring towards the side of, look, we just want to get the best deal possible. And if that means staying within certain things like the single market and so on and so forth, then so be it. Because at this point, once we start to see actual households coming under significant pressure in the months ahead as these Brexit negotiations get underway, this is what makes it very interesting if we were to have, let's say, hypothetically, another election, for example. Because at that point, actual people like you and I in Britain would be feeling a lot more of the pinch. So then how would that affect their decision making going forward over this idea of the future of Brexit and Britain in the EU? Okay, finally, a quick look at the calendar for today. Looking this morning, not a great deal. Into the afternoon, not a great deal either in terms of economic data specifically. You do have wholesale inventories in the afternoon. You've got JOLTS job openings. The Fed discount rate minutes is really a non-event, but you've also got the API crude oil inventories as per usual much later in the evening. But it's speakers which really stand out, and notably one of the central banks which has seen probably a miscommunication, i.e. changing of view of policy stance, or at least widening the spectrum between the doves and the hawks, has undoubtedly been the Bank of England. And today, at 2 points, you've got first of all, Andy Haldane, the Bank of England chief economist, who, former dove turned hawk, is speaking at 10 o'clock this morning. And then you've got Bank of England NPC member Broadbent speaking at midday. Now, just going on the Bank of England website, if you just go on their homepage, what you can do as preparation is look on the right-hand side here. You can see then the actual schedule on who's talking, what time, and is there text to be released. Now, As you can see here, Andy Haldane is a panelist at the Essentials of Numeracy launch event. So not on topic, but just given Haldane has been of focus, given his change in stance, I would definitely be keeping an eye in case there's any media Q&A thereafter. There's no text to be released, though, is what they're suggesting on the Bank of England website. However, the opposite case for Broadbent, there is text to be released. Ben Broadbent's speech to the Scottish Council for Development and Industry during a regional visit to Scotland. So, although, again, that's not directly on monetary policy, could be some comments on the economy, just given the context of the event. So, definitely 2 events just to be mindful of if you're trading the pound later on today. Going in the afternoon, ECB speaker, you got Fed's Brainard. She's always interesting because she's probably one of the most dovish members who is a voter on the FOMC, and is talking about balance normalisation. So as a relevant topic, relevant person, and someone of a dovish nature. So keep an eye on Brainard, and then you've got Kashkari speaking later into the evening. Okay, guys, it's your morning briefing. So have a good day. Pretty quiet for this morning from a calendar perspective, as just discussed. So likelihood things will pick up a little bit as we go into the North American session. So have a good day, and I'll see you in the chat room. Thank you.